Okay, I'm going to kick off today's webinar. The title I've decided to call it, although I'm not sure quite how I'm going to keep to this script, is Q2, which of course is the quarter that we're in now, and a 360-degree view of global financial markets. Now, it's not going to be pure market commentary. There's going to be a bit of education in here as well. I'm going to talk a little bit about how I see the world, some of the process, some of the inputs that I use in my trading process. And of course, that's kind of what we're trying to achieve here is a trading process right from the start of identifying opportunity, getting your head right into a point where you are getting to the final echelons of the process, which of course is the analysing of how you've gone throughout the trade and what you can do to improve. So, we're looking at parts of that trading process which we look at. And for me, that's really about the trading opportunity and assessing probability, assessing risk, assessing position sizing, which of course is really so key. I mean, the two things that I ask clients when they're coming on board is one, what is ultimately that you want to achieve from your trading account? The first thing, of course, is most people say, I want to grow the capital in my account, and that's absolutely fair. I think everyone has to do that. That should be your primary role. It's a question of how you go about growing that capital in your account. Do you want to be a gambler, or do you want to be someone who's got a bit more structure and a bit more process? And I think, if you can open up that's great. But the second point, of course, is managing risk, making sure that you've got correct position sizing. And that's kind of the area that we're going to be focusing on a little bit today. So we're not going to go through the whole trading plan. I mean, if you go to our website, if you go to YouTube, our channel there's just such a ton of material around trading plans. I want to touch more on the idea about something about implied volatility and getting into that sort of structure about how you can use that as a sort of a new technique to get correct position sizing. So the first thing I'm going to look at is just set the scene a little bit. Where are we today? And the first chart I'm going to look at is here on the left-hand side. We're going to look at this one here, which I borrowed kindly from Goldman Sachs. Just give you a little bit of an understanding about how 2019 is shaping up. I mean, it's obviously been a very, very, very good year for markets. Depending on obviously if you've been short a lot of these assets, then and you've failed to adapt and continue to hold them, it's been a tough time. But if you put everything into a total return perspective, so we're looking at the returns of the asset on a capital appreciation plus any dividends and obviously interest payments that need to come out of there as well. So what is the total situation that you've got through there? So obviously crude oil's done very, very nicely. That's had a very, very strong run. They haven't included iron ore. That's obviously had a very strong run since those lows. Tech, NASDAQ obviously done very nicely. NASDAQ 100, consumer discretionary. So it's quite a bit of a US-centric look at how things are going. You've got small caps there, the Russell up 18%, S&P up 16%. This is a snapshot from Monday. You can see that all these markets have done exceptionally well in 2019. You've got investment-grade credit up 5%. 10-year US Treasuries even made a 2% gain. So the risk parity funds obviously doing quite nicely there. Gold's probably had a little bit of a pullback now. We're going to touch on gold a little bit there because I've been a gold bull for quite some time. That position now has shifted somewhat, and I'd certainly be trading that from the short side at the moment. So I'm not a gold bull. I'm not a gold bear. I'll trade price as I see it. Do not fall in love with a position. You've got to accept what's going on in the market. We're going to touch on gold there. So it's a little bit more of a tough time for the macro hedge funds out there. They've really been underperforming the market this year, but you can see that it's been a fantastic year for markets more broadly. In the FX market, the CAD's really been the best performer year to date, up 2.6%. We've had the pound up 2.5%. The Aussie dollar is starting to look quite good. We're going to touch on the Aussie dollar because I think there's some really, really interesting opportunities that are going to come out probably over the next couple of weeks, which we want to look at. The NOK's done all right. I mean, obviously, that's been a function of what's been happening in the crude price, being up 38%. Brent prices around the same as well. And the euro's looking quite interesting as well. So giving you a bit of perception and also what's been happening on the quarter. So again, the NOK and the Aussie dollar right up as the standout ones. I'm not going to touch on the pound because, to be honest, I'm thoroughly over Brexit. I don't really want to talk about it for the foreseeable future, and I'm sure most people in this room are probably over a little bit of Brexit as well. And we'll probably get back into that. But the fact is, I think I'd expect the pound just to probably trade sideways in the next few weeks. And there's probably, if you're a range trader, put a Bollinger Band on that, and you're probably going to have some good range trading opportunities in the pound. But I don't want to touch on that today. It's a whole webinar in itself, and I think most people are pretty tired of that at the moment. So just giving a bit of perspective on where we are at the moment. I guess the question is twofold. One is what has genuinely caused this repricing of markets? What's caused this goodwill, and can it continue? And how does it feed through into some of the products that you guys will be trading, indices, FX, commodities? I'm not going to touch on individual stocks. That's not my bag. I'm going to talk about global macro and how it's influencing price discovery in the big markets that we sort of look at. And I think it's probably quite interesting to say that at Pepperstone, we are going to be rolling out new products fairly soon. So there's going to be a bigger range. We're going to be looking at things like volatility futures, VIX. We're going to be offering interest rates, some fixed income products. A bigger range of indices, bigger range of commodities. So there's going to be great opportunity in terms of these macros that we can express those opinions. Another bit of housekeeping before I sort of soldier on. The handouts you can see there, so you can, rather than ask me for those slides, you can actually see them yourself there. So, and this will be recorded, so if anyone wants the recording, you'll get that sent, that will get automatically sent to you guys anyway. Okay, just getting a bit more of a perception about what the big dogs are doing out there. This, I think, really gives a summary about what people are thinking. And I think this sets the scene for what we're looking at throughout this webinar. First of all, if we go on to the Bank of America Merrill Lynch Fund Manager Survey, and this is a really important survey for me because it comes out every week. Bank of America Merrill Lynch will send this out to, I think, about 239 panelists across buy-side funds. They control in total amounts around $664 billion. So, you know, it's a little bit that when most of the world's investable capital is replying back to this survey, we listen to it. It tells us what people are thinking and how they're positioning their portfolios. It goes into a lot of different questions, but I've pulled out two slides which I think are really interesting. The first one remains, what is the biggest tail risk to market? What is the biggest concern out there? And it continues to be the trade war. And it plays into the big picture that I'm really quite interested in. It's not necessarily about the trade war per se. It's how the trade war fits into what I think is the Mac Daddy of macro concerns, which is the global growth story. Are we going to see a global slowdown from here after what we've been seeing? We are starting to see some stability in the data flow. Or are we going to start seeing better times coming through by the sort of rejigging, the recalibration that we've been seeing from central banks? So we're at the kind of, think about how we're at this kind of equilibrium point. We've had the big move in markets. Central banks have come to what I believe is probably a more realistic structure. They were too tight, I think, and I've got a great chart to prove that the Federal Reserve were too tight, and actually that Donald Trump probably was actually correct in his assumption that the Fed were too tight in December when they raised rates. But the biggest tail risk remains that a trade war is the biggest tail risk to market. Obviously, if we see in the next couple of weeks that it breaks down and the markets say, look, we've had enough of this progress talk, and actually it looks like we're not going to get a deal, then yeah, I think then we are going to see volatility pick up and we're going to see risk aversion kick into market because quite a lot of it's priced in. So the big money out there, $664 billion US dollars worth of investable capital. The biggest concern is trade war. So if they're concerned with it, I'm concerned with it, and you guys probably should be as well. Now, in terms of what's the most crowded trade, I think the most crowded trade is one that we can see in the positioning in markets. I'll cover that. It's something that we could probably see in the flow data. It's something that we can certainly see in the price action and technicals when things get a little bit extended. But the most crowded trade that we can see going through April, and bear in mind this came out on Monday, is short European equities. So, you know, it's quite interesting if I go to the charts of what we're seeing in European markets at the moment. And if I scroll into the DAX, and you can see this move where, you've got the stochastics at the top showing its top end of the range. You've got the RSI pushing into 70, showing the rate of change is firmly to the upside. Yeah, the DAX at the moment, it looks just a really strong market. You know, we've had the breakout. We've come back for the retest. It's holding the 5-day exponential moving average. I really like that. When you're seeing price being contained into the 5-day exponential moving average, it shows that there's really strong momentum in the trade, and you're seeing that here. It's broken the sort of longer term downtrend. It's traded through this through the resistance level. It's come back to test the resistance level. It's making higher highs, and if we go back to the chart, the fact that the fund managers say that the most crowded trade is short European equities, obviously that's a reflection that everyone had this dire view about what's happening in the European economy. We'll have a look at the DAX. I think personally the DAX in Germany, which I think is, to a lot of the index traders we see, a lot of people say it's the perfect market. It has just that really nice amount of volatility. On good days, you'll see a 2% move. It respects the technicals quite well. It's got 30 stocks in there, so you don't have huge diversification. But it is, a lot of people is, on most days it'll actually be our most traded indices. So I think that's a really good market at the moment. And the fact that it's the most short European equities, the most crowded trade, you're clearly seeing people unwind that. So I think that's a market that's very much on there. If I'm looking at an equity index, the fact that the big money still see European equities as a short position, and we're seeing that market move up, I think is a really clear indication that people are unwinding those shorts. Now the question is once those shorts are unwound, are we going to see organic longs coming through and people putting new money to work? And I guess there's probably a bit of that, but Europe is very much a leverage play on what's happening in China. And we'll touch on China as well. So what am I going to look at today? I really want to look at a macro overview of Q2. What's the sort of diverging messages we're seeing in markets, the implied volatilities and effects equity bond markets. And, if anyone reads my daily fix, daily newsletter that I put out, I really focus on implied volatility as a guide. Now we're not trading options. I'm not an options trader. I do trade options myself. We don't offer options at Pepperstone. What we want to use is implied volatility for spot FX trading. And if you're an options trader, you'll understand the importance of implied volatility. It's one of the key measures, along with things like time and whether you're in intrinsic value and all these other factors. But certainly implied volatility is one of the key aspects. Most of you guys out there will probably be using volatility in some shape, some capacity, probably in realized volatility. So what has volatility been? And you'll probably be using something like the average true range, which you can see on this slide. It's the calculation here, the difference between the current and high and the closing low, or the current low, the value of the prior close, the current high, and you can understand how that works. But also you're going to be using things like Bollinger Band and other momentum indicators, which contain quite a lot of statistical information through there. But so if you're using a Bollinger Band, if you're using an average true range in some capacity to understand how the sort of moves we've been seeing and how you can use those to assess risk and how much risk you want to take on in a position, therefore understanding how much your position size is going to be effectively in the market, which of course is fundamental to trading. You probably would have used these indicators at some stage or form. I don't want to use realized volatility in this situation. I want to look at implied volatility. What is the market looking for in the future to say, what is the expected dispersions from an expected mean? That's exactly what volatility is. Volatility is directionally agnostic. It can be higher, it can be lower in terms of the market price, but it's saying this is the mean, this is the average, and these are the expected dispersions of the data flow, where price is going to go. And of course, the wider those expected dispersions, the higher the implied volatility. That's what it is. I mean, we're not trading options here, but what we want to understand is what is the expected volatility in an asset, and therefore we can understand whether people see increased risk, what is the expected move over that time period, and then we can create, we can understand how much risk we want to take on in a position. And for people who read my daily fix on a daily basis or a regular basis, you'll understand that I focus on this quite a lot. And we're going to be doing daily webinars soon, daily live updates, where we'll be talking and showing people how to this, because it's very, very difficult to get this information real time, and we'll be giving you that information in our some of daily updates. We're going to look at positioning and sentiment market. We're going to look at global growth. We're going to look at interest rate pricing, which of course affects markets. Is kind of like a derivative of interest rates and bond market pricing. And the markets at the moment are pricing in a huge degree of rate cuts coming forward. And what's that message they're trying to tell us? And I'm going to look at some of the macro thematics. So this is really what I'm trying to do in terms of my process. I want to have a look at the message that markets are telling me right here. I want to have a look at implied volatilities, the expected move, and what potentially could change those volatility structures. I want to have a look at positioning and sentiment, and that will give us a really good idea about the sort of risk-reward trade-off there, the sort of probability of an extended move. Is positioning too one-sided, and can that boat sort of tip a little bit? And then we're going to have a look at interest rate pricing, because again, that sort of information to a lot of people is very hard to get. I'm going to be using a Bloomberg terminal today, so I'm going to give you some sort of real sort of institutional style information in that sort of sense, and hopefully it's going to be quite important to you there. I'm just going to quickly touch base on Ashley's question. So the idea behind implied volatility is knowing possible moves for the week or month in pips, either up or down. Yeah, great question, Ashley. That's exactly right. So it's not necessarily the volatility that I'm significantly interested in. If I bring up, let's just bring one up, for example. If I go to, so this is something that I look at on an everyday basis, right? So what we've got here is my 1 week volatility, my 1 month volatility, my risk reversals, and we'll touch on exactly what those are. But this is something that a lot of institutional FX traders will look at in their daily basis. So look, most people will use 1 month volatility, but that's going to be options traders. Now we're trading spot FX in this situation, so we probably wouldn't hold a position for 1 month. That's probably very, very low chance that you're going to be holding an FX position for that chance. Some people do, but the average hold time, I think, is around 4 hours or so, including people who are looking to scout the market. But let's use a 1 week volatility. I personally like to trade swings. I will trade positions as well, but I will hold positions for 1 week, and that's why I like to look at what's happening here. Now, it's not necessarily so important to have a look at. Let's have a look at euro dollar here. We can see that we've got an implied volatility over the week of 4.24%. So if I graph that, the important situation here is to understand where it is in relation to previous moves. So you can see here that it's trading at 4.24%. And if I take it back, you can see that this is the lowest levels really since 2014. So the market is just really, really calm. Now, what I can actually then do, and again, this is something that's fairly proprietary to me as having a Bloomberg terminal, which costs I don't know, 25 grand a year or so, is actually work out what the expected move is. So if I put this into what we call a straddle option, you guys don't need to know this, but what we can do is we can actually say, putting it into the Black-Scholes formula, which you should probably Google if you're interested, is I can actually say now, with that implied volatility, what is the expected move? And there's time premium and other factors involved over the next 7 days. Let's have a look at 1 week vol. So given that implied volatility is very low, they're looking at all the data that's coming out both in the US and in Europe. We've got PMI numbers tomorrow, which I think will be very interesting. But there you can see that 1 week volatility, we can see there the somewhere midpoint of that, gives us a 57-point move over the next 7 days. If I put this to 1 day, so overnight, so what's the expected move on the day? 36 points. So the market is telling me that they expect euro dollar to move in spot up or down, either side of the current spot price of 113, up 36 points or down 36 points. Now that's pretty low. We've seen when we charted implied volatility, that's the lowest level since 2014. So what I would actually do in this situation, I'm sort of jumping the gun, I probably should have done this in the next question, is I will say to myself that I really need my stop loss at least 36 points away from the current spot price. Now, that could be 50 points, it could be 70 points, but I know that 36 points is quite a small amount. So therefore, I can adjust my position size. If I'm taking less risk by having a closer stop, I can increase my position size accordingly, and so on and so forth. If the implied volatility is very high, the market's expecting big moves, then of course in that situation, I'm going to take more risk on by having a wider stop. I therefore need to adjust my position size accordingly. And it's when you can do that you can really understand. Of course, where do you put your stop loss? I might put it behind a previous low, Fibonacci retracement level. That really depends on the market itself. But I'm using this as a guide. And of course, markets can be wrong, but the consensus in the market is that they've assessed everything that they know, and they've made the decision that in the next 24 hours that the euro dollar is going to trade up or down 36 points, which is pretty meager, to be honest. If we do it over, say, like a month, if I'm going to hold a position for a month, we've got 126 points, and of course you can do that for different currency pairs. So if we look at Aussie dollar over a week, what's the market expecting? A 61-point move. So if you have a look at Aussie dollar at the moment, and you can see what's been happening here, where we'll go to my MT5 platform here, and you can see that the Aussie dollar's actually broken through this downtrend. It's actually broken through the 200-day moving average for really the first time since we go back to March 2018, so pretty much this time last year. And I think that's quite an interesting situation. If we really hone into what's happening in the Aussie dollar, there you can see that the price is moving up and hugging that upper Bollinger Band there. So it's hugging that two standard deviation move from the 20-day moving average. It's doing quite nicely. Now, why is that situation? We can touch on that in a moment. But the market is saying that they expect a 61-point move over the next week. So that probably means that we're probably looking for somewhere into sort of the 72.60, 72.50 region as a potential move. Now, of course, markets can be wrong, and that's why people will buy and sell volatility structures through straddles and strangles, and that's why you take a view, and I think that's why options can be quite attractive in that situation. But knowing what we know, with everything that we've assessed, the market, the consensus is there we're going to get a 60-point move. So that's really how I'll use volatility. Now, that there are ways of getting hold of that. I'm not sure if you Ashley, if you can get that on your Reuters icon platform, but this is something that we'll be discussing on a daily basis for clients in our daily webinars and our daily live broadcasts and the expected move. So I think that's quite important and for clients. Not the ATR will look at backwards, it will look at realized volatility. I'm using implied volatility that's looking forward at forward markets and what's expected over the data flow. Okay, so I'm going to have a look at some interesting charts, and I'm sort of going to ad-lib this as we go using some of the sort of charts that I've set up over the time, which I'm hoping you guys are going to find quite interesting. But I'm going to start off with, taking it back actually exactly why we've gone here. What is it exactly that we've seen coming through? So if I have a look at a chart that's fairly close to my heart, you can go back to this top pane here where we can see the S&P, the US S&P, and you can see, sorry, the S&P is this one here, the white one, and you can see that really since December 24th, Christmas Eve, we had this really, really strong move up, and we'll cover the S&P in a bit more depth in a minute, but you can see that this pivot that came through here, and we've just seen this really nice move up. Now, what exactly that's caused that? Now, I think it's probably the Federal Reserve moving to a more realistic structure. I think when the Federal Reserve pivoted, as the term that everyone uses, what we ended up seeing is all markets moving in alignment. As you can see from the VIX, which is the implied volatility in the S&P over the 30 days, you can see that was trading around 36%. That collapsed. We're trading at 12%. There's really no life in these markets at the moment. That's a really good broad measure that implied volatility in the S&P had collapsed. Now, that allowed a lot of the sort of volatility targeting funds to reduce cash levels and start getting back into market. There's a huge amount of hedge fund money that's out there at the moment, which is dictated to by volatility in itself. I mean, we don't necessarily get to see this flow. It's a lot of what goes through the investment banks, but they will look at the implied volatility in various markets, and they will say, based on that, we can be this invested in risk assets. And I think that's a really strong situation. When vol started moving lower, there's no doubt that we started seeing people covering their short positions and people getting back in. Another issue, which again, we're sort of getting into applied finance, and apologies if you don't have a degree in applied finance, but you've got to understand the importance that the bond market has on equity indices. I mean, it has such an important impact on FX markets and rates markets and to a lesser extent commodity markets, but it has a very, very strong impact on equity markets as well. And look, if you see what started to happen here is the US 5-year real yield treasury. So this is the US 5-year treasury, and we inflation adjust that. So this is the real return that you're getting in any sort of shape or form. The investment that you're getting, the returns that you get are the sort of nominal returns, and what we want to do is adjust that for inflation to what we get a real return. So we're looking at the 5-year US Treasury, the yield, the expected yield that you're getting on that over a 5-year period. Okay, I'm getting people saying they can't hear me. Yeah, it's all good. Okay, perfect. So you can see here that real yields started falling. Now that's really, really important for markets. Real yields, it makes the cash flows of the businesses in the S&P much more attractive. You will you bring those cash flows back to the present day. I'm not going to explain that in great depth, but when you're seeing real yields falling, it makes the cash flows of the equity just that little bit more attractive. Now, it also makes the earnings yield and the dividend yield much more attractive, and that's why the Australian market's done very well. There's not any market out there in the world, in the developed markets, which is more attractive than the ASX 200 in terms of the yield. If I go here into this market here, you can have a look here at these different markets that we've got: the S&P, the Dow, you got the FTSE, the IBEX, the Nikkei, Hang Seng's S&P, CSI 300. But if you look to the far right, you can see the dividend yield, and you can see the ASX 200 as a dividend current yield of 4.78%. Yeah, that's higher than any other market apart from the FTSE 100 in that situation. So, of course, in an environment where we're getting falling yields, it reinforces the idea that the earnings yield, dividend yield that you can get in the Australian market is just a little bit higher there as well. Where was I? So implied volatility goes down. You've seen a situation where the oil price started moving up, and I think don't discount just how important that was as well. And then interest rate pricing. You can see here on the far left that we started off in November with about 25 basis points being priced into US rates markets of hikes. And then they started really coming off as volatility kicked up. Implied rate hikes came out of the market, and we actually got to a point on the 27th of March where we had about 46.5 basis points of rate cuts being priced in over the coming year and a half. That's nearly 2 rate cuts coming through. And that's where we are at the moment. We're left in a situation where we've still got about 1 rate cut being priced into US markets over the next 18 months or so. So the market is saying that they still expect the Federal Reserve to cut rates. But we'd moved into this situation where the Fed had given us a nice warm hug. They'd basically come out and told us that they were going to support risk assets. Implied volatility fell. Oil prices started moving up. Largely as also a consequence of what we saw from OPEC. And rate cuts came through. The problem is we've got to a point now where real yields have started moving up. Interest rate cuts are getting priced out of markets. And at what time does this become a bit more problematic for markets? Now, it's no doubt to me, and this is sort of a little bit technical, and I apologise, but when we're looking at whether the Federal Reserve had tightened too much, what academics will look at is the Fed funds rate, so the US interest rate, on a real basis. So again, we're adjusting the Fed funds rate, the US interest rate, for inflation expectations. I won't go into that too much depth, but what we're having a look at is the inflation adjusted Fed funds rate, which is this pink line here. And what we're seeing is against the natural rate of interest. So this is effectively the interest rate that you can see in the US, which is the perfect policy setting for the level of inflation and for the level of expected employment. So what is the perfect policy setting that the market believes is there for the expected level of employment and inflation in the US market? And very rarely do you see the real Fed funds rate trading above that level. And when we do, we usually assign that the financial conditions, that the policy setting in the US is too tight. And that's something Donald Trump had alluded to. Now, I don't think he'd been looking at this chart. I think he was just trying to boost the stock market for obvious reasons. He sees the stock market as a voting mechanism on his tenure as the president of the US. But you can see that the time when we had the real Fed funds rate above this was in 2000, and then again in 2006, 2007. We, of course, know what happened in both of those situations. And in both of those situations, we saw the US dollar selling off. And I believe that if you can get your US dollar call right, you'll do pretty well in most of your asset allocation. And there are signs to me that I think that the US dollar is seeing highs now. That said, if we do have a look at the US dollar, and I'll go back to the MT5 chart. So again, the importance of the US dollar call. If I go back to the dollar index, so the dollar index obviously doesn't get as well traded as euro dollar or Aussie dollar, but the US dollar is a dollar index, USDX on MT4, MT5 is a really good reflection of the US dollar traded against the basket of currencies. So if it's going up, the US dollar is strengthening against the euro, the pound, the yen, and a couple of other currencies as well, but about 57% against the euro. So as you can see here, as I scroll out, we've kind of got this uptrend that's in place. You can see it making lower highs, or lower low, or higher low, should I say. So the trend is still there. We haven't closed through there. We've got the 200-day moving average, which is holding up play as well. But I want to see a situation where, this resolves itself. At the moment, there's not. Let's put that on a weekly chart. I think we can see a better structure. Nope, doesn't like it. Okay, so we've got a situation where, as it stands at the moment, um, there's not really much in it. There's no real clear trend. It's going sideways. We're sort of making a bit messy price action. It's not really giving us a clear signal. So I'm not going to recommend doing anything with the dollar at the moment. That said, I think you have to put this chart on your radar, because if you can get a break of 97.70 around this kind of this ceiling that we've got in this here, I think that's going to be very powerful. Now I'm going to show you some charts around implied volatility. Obviously, we saw the one in euro dollar a minute ago. What's the name of the website that you're using? That's my Bloomberg terminal, and this is something that is it costs about 25 grand a year. So it's an information portal. Tim, I'm not sure the answer to that one. Why does it offer? I'm not sure the answer to that, I'm afraid. I'll have to get back to you. So if you reach out to me, I can give you a definitive answer as to why. I guess maybe the weightings towards towards the different currencies. I'm not sure, but if you write to me, chris.weston at Pepperstone, then I'll .com, and I'll get you a definitive answer on that question. But yeah, I think if we get a break of the ceiling here, then I think that would be a very powerful situation, in a situation where the global economy is still seeing vulnerabilities in economics. I think a stronger dollar would not be good, and I think that would be very powerful. I think a break of that level would see a continuation. I think it would be a matter of time before traders started talking about $100 index. I don't think that'd be good. Therefore, I think if you get a price rollover, and on the weekly chart, you can see divergence between the price action and the stochastics. And we can get a move through the 200-day, we get a move through the uptrend, and preferably if we can get a lower low through this pivot here, then I think that would be would obviously be very positive for risk assets. Obviously, be very good for gold and other factors there as well. So I think you have to, this is a chart that I've definitely got on the watch list, as I have done with euro dollar as well. I think if you're looking at euro dollar weekly, we've got this. You've got this wedge pattern in play. Again, this needs to rectify itself. So there's no really clear trade for me in this situation. I'm just waiting for the market to force me into a trade. These can be quite powerful situations. So I think we're just waiting for the market, again, just to force the issue, force the trade. It's similar to a dollar index. I think, with implied volatility so low in these markets, if we do see a break of this, and it will happen eventually, of course it has to happen, then I think that will force and change the opinion about what's going on in markets there. So I do think keeping these on the watch list is certainly very positive indeed. But if we can go back here, we can see a situation where Fed policy at the moment is above the natural rate of interest. So we do have a tight Fed policy as it stands at the moment. Right, I'm going to go to another chart. The other issue, again, we're going into the bond market, is what happens when we get an inverted curve. Now, again, this is sort of getting a lot of traction, this whole idea about flattening yield curves and inverted yield curves and various factors. And I think the institutional world's overly bothered. I think the journalists out there make a big song and dance about the inversion of the curve, where long end yields have a lower yield than what we've been seeing in the front end. But I thought this is quite an interesting chart, where we look at the difference between 2 and 5 year US Treasuries, and the impact that we tend to see when we do get inversion. You can see here that we got an inverted. So basically, 5 year Treasuries trade with a lower yield than what we see in 2 years, and 68 days later, you can see here that the Federal Reserve started a rate cutting cycle. you can see here in 1995, after a strong downtrend that we saw nearly inversion, but we got to a point and then we started seeing the Fed cutting rates, but we didn't get to that point. That's the only part in this cycle that we had to look at where we didn't see inversion before we saw a rate cutting cycle from the Fed. You come down to here into 1998, we got inversion, we saw a bit of a steepening, so 5-year yields moved up more aggressively than twos, and we started seeing rate cuts coming through. We've got the same structure in 2001, and we saw a fairly aggressive rate cutting structure from the Fed. You go into 2007, and yeah, again, you saw 297 days, probably the longest period that we saw here. Period inversion, so 2-year yields trading lower than 2-year yields, and we saw a very aggressive structure as we went into what was the GFC. Now we've got that same situation here, so we've had a strong move lower, we've got into negative yields, although it's pushed up a little bit now. The question is, of course, will we start seeing rate cuts playing through? You know, over the last 5 or 6 times that we've seen this inversion, we've seen rate cuts playing through. Now I'll go into the rate cutting structure in a minute, but there's one more chart I just want to have a look at around that situation, which is this one here, because I'm sure there's plenty of people out there that do think we're going to get rate cuts from the Fed. I'm still not so sure, but if we have a look at what's been happening here, where we see periods of pauses, which of course we've got at the moment, you can see there that these areas of red represent recessions in the US. You can see that we had a pause, the Fed cuts rates, this is the Fed funds rate, into a recession. We can see an element of pause for a number of months into a recession, rate cuts. A big pause, rate cuts into a recession. A big pause, rate cuts into a recession. You know, if we look at where we're going now, we're arguably going to see, you know, a rate cut, a pause, and as you can see there, you know, we're probably likely to, if anything, start to see rate cuts coming through. Does that indicate that we're going to see a recession? What we always see after a pause, you know, for the last 20 or 30 years, is after a pause, we tend to see a situation where we go into a recession. Now, that sort of coincides with that first chart that I showed, which is that Fed policy at the moment is probably a little bit too tight if we use the academic measures. What else have we got? If we have a look at US rates, now this is what's priced in. So we go into this idea that when we see periods of pauses, we end up going into a situation where the Fed will cut into a recession. Now, what is the market already telling me here? Now, this is the euro-dollar futures. This is a tradable instrument which you can use to express a view on interest rates. We will be rolling these out to clients fairly soon, probably in mid-May, where you can actually trade a view on what's going to happen with so Manfred, yeah, I'm not going to go back to that chart, but what you can see on there, if you watch the re-recording, is it was the time from when we actually saw the yield going negative to the point where they started. It was the low point in that yield move to the point when they actually started cutting. So that period of time, the number of days, is the time when we actually hit the low point to the point when we actually saw cutting. That's the number of what that signals there. But what we can actually see here in the euro-dollar futures, remember, currency markets by and large are a subset, a second derivative of what we see in the rates market and the relative rate pricing structures you see. You can see here, this is the difference between what's priced. Well, this is effectively what's priced in between June this year and December 2020. So what we're looking at is how many rate cuts are priced into US markets from June this year to December 2020. And you can see it in October, we had around about 27 basis points, or just one rate hike being priced in. And as risk came out of the market, people saw slowing growth in the US economy, and certainly in China and Europe, we started seeing people pricing out rate hikes. We got down to zero, which is here, and we started seeing rate cuts being priced in. We got down to a stage where over 2 rate cuts were being priced in over that period. Now, we started seeing somewhat better data playing through. We saw that today. I'm sure a lot of people saw what was happening in China. We've seen somewhat better data in Europe, but it's still very precarious. But certainly, China is leading that situation, and we've seen rate cuts being priced out of markets. Now, how much higher can this go? We've still got 25 basis points or one rate cut being priced into US markets over that period, and that's kind of in fitting with what we've been seeing from this traditional playbook where we go on a pause, we go into a rate cutting cycle. That's what we saw the 2s and 5s charts. So the market is saying, knowing what we know, there's still a very strong probability we're going to get a rate cut going forward. Now, I'm not sure how many people in this room saw what we saw the other day from both Charles Evans and also from Richard Clarida, who's the Fed vice chair. Charles Evans, the Chicago Fed chairman. Now, he came out and said, and I think this sort of fits into everything I'm saying here, and it's something that we really have to focus on. We're looking for trigger points that could cause these moves, and that's exactly what we're looking for in this playbook for this webinar. Is what is the trigger points to make a central bank move? We know what they are in Australia, and I'm going to speak on them next. But we now know what it's likely to be in the US. So what's causing this whole thing to come together? What's this period of pausing, and then potentially, as the market is portrayed, I just showed you there that we're expecting 25 basis points to be cut in the US markets. What's going to cause that? Now, Charles Evans said a couple of days ago that he's still fairly optimistic on the US economy, but what would they cause to have an insurance cut would be if we saw core inflation going down to 1.5%. So we're getting new news. We're getting a little bit of information that give us triggers by which we can work with as strategists and traders, fundamental traders. I know we always use technicals, and some of you will automate your strategies as well, and that's fantastic. But as a fundamental guy, I'm trying to understand what is going to be the trigger. What are these guys looking for to be the trigger to change rates, and therefore the economic data that suits that point is going to be just that little bit more sensitive. And core CPI, he said at 1.5% would be the trigger for them to cut rates. So we can actually see here that at the moment it's 1.8%, but it's starting to head a little bit lower. If we got it through 1.5%, which is a big if, but if it does, Charles Evans said that, and he's optimistic. He's a dove, but he's optimistic. That would be the trigger there. So again, we come into this idea about what could be the issue that the Fed policy is too tight. We've seen that chart. If the Fed are going to start cutting rates and it's not necessarily priced in, how's the dollar going to react? Now, I personally believe that we're going to see a weaker dollar. There's going to be a lot of people here who completely disagree with that, and that's fine. I'm not going to act on it at the moment because, as I showed you with the what's been happening in the weekly chart of the dollar index, is that this chart, this setup at the moment, is giving me absolutely no probability. So I've got a fundamental view of what could happen, but we always wait for the price action. We want the flow, the ebb and flow, the fund flow, the capital flows to really give us the idea that the body of the weight of capital is going in the direction of where our fundamental view is as well. That's how you get a higher probability outcome. If my fundamental view is not backed by the flow, the ebb and flow of the market, I will not back that fundamental view. That's really important to me. I'm not going to say I'm better than the market. I'm not bigger than the market. The market is the market. If I'm losing money, the market's right. I'm wrong, and I need to get out of the trade. But I'm waiting for that market to tell me that perhaps the fundamentals are right. Now, I could be wrong, and if we could get a stronger dollar, and that needs to be assessed as to why that's happening. And that would happen if we get a break of this green line. That said, if we start seeing a break of the trend, we start seeing a break of the 200-day moving average, we get a lower low, then it's on. My view is on, and I'm going to start acting. I'm going to aggressively start talking about weak dollar positions, and I'm going to be looking at opportunities in the market outside of the US dollar that benefit from a weaker US dollar. That's the strategy that I believe has to happen. Everything around the US dollar is real. Now, what we've been seeing, I want to touch on what's happening in China. So we've got our trigger here for why the US would start trading rates. Now, he's one man, but I think he's fairly representative of a lot of people on the Fed. If we did see inflation down there, the Fed will look to start cutting rates. But I think what we have to look at as well is what's happening in China. The GDP numbers were very strong. The industrial production numbers was significantly stronger than what the market was looking for today. But for me, what's really important is the credit impulse numbers, the credit data, is that they are turning the liquidity taps on. They were generally worried about their economy. The question is how much further this has gone. The credit impulse, so what is the level of credit that they're getting and then turning it into GDP? That's moving higher. Total loans for institutions is running 13.7%, which is the highest since June 2016. Yeah, the Chinese have gone away from this deleveraging process. They have ramped up the credit taps, and we're seeing it reacting to the real economy. We saw house prices up 60 basis points in the month. We saw industrial production numbers moving up. We're starting to see stabilization in car sales. So it's great that the Chinese can turn the taps on and we get an immediate impact. The question is how much further this can be for assets. If we go to the Chinese market, I'm going to look at the A50 here, which we call the CN50. Yeah, obviously it's had a stonking move that we've been seeing here really since late December. It trades really nicely. And again, this is a little bit like what I see in Bitcoin. Bitcoin is a FOMO market. It's a fear of missing out. It's a momentum market. When it starts going up, the press start talking about it. People who like Bitcoin go into it. Now, I'm not a Bitcoin expert, so shoot me down. But I think it's a strong momentum market, and it breeds on strength. Strength breeds strength, and I think that's something that happens in the Chinese markets as well. When you're seeing the liquidity taps on, remember this is 80% retail traded, the Chinese equity markets. So when it's front page, the credit taps that are on, that they're stabilizing economic conditions. You do see the equity market moving nicely higher, and that's exactly what we've been seeing. There's something in China when you see your neighbor getting rich. It's a very powerful and emotive situation, and this fear of missing out grips people, and that's what we've been seeing there. Bond markets have sold off very, very aggressively in China. AAA rated credit's been moving very aggressively higher, and the equity market's been moving higher as well. And it's no surprise if you were to go out to here to have a look at. Let's have a look at iron ore. I haven't actually got a pre-populated chart, but for anyone who's trading Rio, the stock was down pretty heavily today. If you have a look at what's been happening in iron ore, and let's compare this to the Chinese equity market, you can see here a fairly strong correlation. Now, is the Chinese equity market a reflection of iron ore, or is iron ore a reflection of the equity market? I think there's probably a bit of both, but iron ore's had a nice move up because of what's been happening in Vale, and Vale now are allowed to actually start increasing production again. But there's a reasonable correlation between the two. That's broken down a little bit now, and I think that probably will break down. But effectively, what we've been seeing is this huge bid in Chinese markets, and the question is, can this continue going forward? Now, the question that we want to do is, I personally don't want to be in the Chinese equity market now. If you have a look at the price action today, we've seen this doji candle. There's a little bit of indecision playing through. Of course, that needs to rectify itself. So I'm not going to be looking to put any money to work in the Chinese market after this move here. But yeah, if you do see a situation where this kicks up, I'd probably be jumping up, and that's again a strong momentum play that we've been seeing in the Chinese market here. So the CN50 is effectively what we call the A50 futures, which is the top 50 Chinese companies where they're listed on a futures exchange in Singapore. You can change the Shanghai Composite. We don't offer that. No one really offers that. The CSI 300, which is a smaller version of the Shanghai Composite, and you can trade things like the Hang Seng as well, where you can see again. I think this is a slightly more compelling setup for me, where after a strong move up, you've seen this consolidation. So I think if you can get a break of this ceiling in the Hang Seng, that would be my trigger. Of course, in the situation when you're looking to trade a move like that, you take it down from a daily chart and just to see how price reacts on the break. How price reacts is what we do as traders. We react to capital flows and price flows. But I think after this strong move up, if we can see a break of that ceiling, if we can see ideally a retest of that level and a rejection and a move higher, that would be a very powerful force. So I don't really want to be looking at the CN50. I think that the Hang Seng looks a slightly better play on China. And again, it's just this idea that the credit taps are fueling better economics. And that looks like quite interesting play. I continue to like the DAX as well. The DAX is a sort of a trickle down view about what's happening in China. Europe is a more leveraged economy to Europe than to China than even ours. I know, fine, we're a big export destination in terms of what's happening in iron ore and gold and various factors there. But the correlation you see between a lot of the Chinese data and European data is very, very strong indeed. So the question is, are we going to start seeing it filter through into better economics in Europe? And I think that's something that we want to focus on. So tomorrow we're going to get the PMI numbers out of Europe. If we do start seeing better data there, then we're going to see a sell-off in bond markets, and we're probably going to see The euro will probably rally on the back of that as well. So there's something we are looking at. But the structure, if we're looking at China, is we are seeing better data. The credit taps have been ramped up. It's started to filter through, and the equity market's already been expecting it and liking what they see there. Okay, so we've seen China. We've seen what's been happening in the dollar. I want to focus now on positioning, because this is something that I look at every week. And the first one I'm going to look at is the VIX. So again, we're going into this low volatility structure, and I want to understand, how people are positioned. And if we do see something that the market's not expecting, how could it affect volatility structures in the market? And of course, you get this kind of concertina effect playing through. If I have a look at what the CFTC data looks at. So the CFTC data is compiled every Tuesday, and it's sent to us every Saturday morning or Friday night in the US. So what we call it the Commitment of Traders report. And it will look at non-commercials and commercials. So non-commercials are people who are using various futures markets or options markets to speculate on market or do various functions, but they're certainly not looking to realize or take delivery of those contracts, but they're managing risk or speculating markets. We can actually break that down in non-commercials into asset managers. We can break that down into leveraged accounts, and we can break it down into dealers and also other reportables. And I look very closely at the leveraged funds. So these are leveraged hedge funds who use leverage to speculate on various assets. They're the ones who are most like you and I. These are the guys who are taking a view on what the Fed are doing, what the RBA are doing, and they'll move money very quickly. So I want to understand how these players are moving money around at one time. And if I have a look at VIX futures on a non-commercial basis, so the speculators, we're seeing a level now where they're holding 164,000 net short positions, the highest short position since 2017. So people are speculating that implied volatility is going to stay low. And that's quite extreme. So these guys have moved that they think that volatility is going to stay low. So what is it that's going to cause volatility to ramp up? If we do see something to ramp up, and again we go to the Bank of America Merrill Lynch survey, which says that probably the biggest surprise would be something around the trade disputes that causes global growth to change. Now we're getting a bit excited that perhaps we're seeing stabilization in global growth. If we don't see that, then of course this VIX future short position is going to come unwound. So I like to use positioning not to trade alongside, but when something becomes a bit extreme, it stokes my interest. If the investment landscape changes and we become a bit more concerned, what's the elastic band here has been pulled quite far back, and we could get this explosion in higher volatility, which then could cause a concertina effect. All these funds which have bought into the S&P and the Dow and the Nasdaq because volatility was low, and it allowed them to put more cash into the market. You could see the yen strengthen as the risk aversion kicks in. It's all how markets are intertwined, interconnected. Now, if I break this down again into not that one. Into those long and short positions, we saw that there was a massive net short position, 164,000 contracts, but we can then break that down into reportable short positions and reportable long positions. So you can see the long positions have been declining, people looking for a higher volatility, and you can see short positions in VIX futures have been increasing. So people have been benefiting and looking for that low vol. So that's a really interesting thing. I'm looking for what's going to cause higher volatility in equity markets. That will probably cause higher volatility in FX markets, which is something a lot of you will be very keen to see because we've got such low ranges. We talked about that when we looked at the Bloomberg chart that showed the expected move in euro dollar and Aussie dollar over the next week or so. If we continue to go into positioning, let's have a look at oil, because again that's been another big factor there as well. You can see that net long positions, so let's take this down here. You can see this is the equilibrium line 0, so this is net longs. We've got 286,000 contracts, so It's been building. It's definitely been building. There's no doubt about that. You can see that, but it's not at extremities at the moment. The market is long oil. Managed money is long oil, but it's not at extremes by any means at the moment. That's interesting. So I'm just getting a sort of holistic view about how everything's being seen. Let's have a look at the Aussie dollar, for example, here, and I've actually broken this down into asset managers. And I've also broken this into leveraged accounts. So leveraged accounts is most like you and I. And so the market is short Australian dollars. This is of last Tuesday. But it's still, we're probably up a little bit more, probably about 6,000 contracts at the moment short. So the market is short. The leveraged accounts, the big hedge funds who use currencies to speculate is still short the Australian dollar. But it does suggest that if we do see a continuation of this better data out of China, and potentially if we see some better data out of Australia, then we can see higher markets there. Asset managers, though, are very short Australian dollars, and that's something that really interests me as well. Let's go into that euro positioning that we've been seeing. Let's actually have a look at the dollar positioning, because again, if we do see a position where that we start seeing inflation starting to head low, perhaps a little bit higher in inflation, these non-commercials, the guys who are speculating on currencies here, do hold a pretty punchy long US dollar position. And we know that the fund managers generally short on European assets, but we've got a fairly punchy US dollar position. So again, am I going to use this to go and short the US dollar? Absolutely not. But again, it just feeds into my holistic view on markets, and it's something that I as part of my process I'm looking at. I'm like, I know the market's long US dollars, but what's going to cause the investment case to change? We do have people who try and short the US dollar based on the commitment traders report. It's a low probability move, but it's something to be aware of, that the market is long dollars. If we do start seeing the Fed really looking at that lower inflation, which I'm not saying it's necessarily going to happen, but if we do, we know the trigger, then that long US dollar position is going to be liquidated somewhat, and that's going to cause an extended move lower. Let's have a look at euro. And again, euro shorts are the lowest, or the biggest euro shorts since 2016. So again, if we start seeing that break of that wedge that I talked about earlier, some of these euro shorts will no doubt be looking to close out in that position. Now I want to focus on Australia, because I know I'm cognizant that we've got 4 minutes left and I'm well over time. But I think Australia is really interesting at the moment because, tomorrow, if we go to the calendar, I'll use the Bloomberg calendar. Tomorrow we've got something that's really important. And Warwick, I'll get to that question in a minute. I just want to focus really on quickly on the Australian side. Tomorrow, if you go back to what we heard from Guy Debelle, and he spoke the other day on the Fed, on the RBA, and he said that there was a disagreement. There was this sort of tug of war between, very weak or fairly weak GDP and productivity against the backdrop of very strong employment, and that needed to rectify itself. So we've kind of got two things in mind, which again very similar to what we've seen with the Fed. One is any kind of uptick in employment is going to be a bit of a concern for the RBA. So if it's a concern for the RBA, it's a concern for us. The other thing is if we start seeing inflation really continue to trend lower, that will be the chance then for the RBA to cut rates. So tomorrow at 11:30 we've got the employment data. The market's expecting 15,000. Let's have a look at sort of the run of estimates from here from brokers. We've got 33,000 is the highest, and that will be from Stephen Koukoulis at Market Economics, and also the low estimate from Barclays at 5,000. I actually prefer, probably the best way to look at that is the sort of average numbers that you've been looking for there. So I'm going to go into this economic release. I'm going to say the 12-month average is 25,000 jobs being created per month. We can have a look at the 6-month average at 26,000 jobs per month. Let's have a look at the year to date. We've got 21. So the average over those different periods is all above 20,000 jobs. So it's a fairly clear that we're going to go into this expecting around 20-odd thousand jobs. But the way I look at this is if we see the unemployment rate ticking up above 5%, that's I think the Australian dollar is going to be quite sensitive. They've given us the triggers like the Fed to focus on, and those two things are employment and inflation. And if we do see the inflation rate tick up above 5%, so let's say 5.1%, what you're going to see is the rates market really open up. next week is the Mac Daily. This is the one you absolutely have to watch. Okay, so you've got inflation trim mean expected to drop from 1.8 to 1.7. This is what the RBA look at. Now, I think if the one you want to look at most closely is this number here, the quarterly number, 0.4%. That's gonna stay on hold. But let's have a look at what the economists are saying here. So that the low estimate is 0.4, 0.5. I personally believe that if we get a number about 1.3%, and we actually see an employment number that comes around 5.1%, then the RBA will arguably open the door to rate cuts in May. They will give a very, very strong indication that they're going to cut in the July meeting. So these numbers are very important. It may not happen, and we may actually see really strong job creation in that situation. So in which case, if we go back to that Aussie dollar chart, that we'll probably see the market building on this. We'll continue to hug the uptrend there. The 20-day moving average is probably a bid there. Probably you're going to see, if you put a 5-day exponential moving average, you're going to start to see it trending a little bit higher. Some of those short positions we talked about continue to close out, and you've got a move up into the sort of this swing level here. But again, I think if you're looking at the playbook, and that's what I do as a strategist, I'm kind of looking at the permutations of what can happen at any one given time, and trying to frame about what's the probabilities of something to happen. Because of course, anything in life, in markets, you can never be certain. Nothing can ever be certain, but we can work on a probability scale. So what's the probability of this happening? What's the probability of that happening? And if I go into tomorrow's number, I don't have a position on the Aussie dollar. But if you can see there, where if this unemployment number comes out at 5.1%, the market will say, if we get a weak CPI number, then it's on. The market, we are going to get cuts as a path of least regret from the RBA. This trim mean number tomorrow comes out at 0.3, then it's on. So what I would do in this situation is I'm going to go out and I'm going to have, we know that the volatility on the 24th is that. Let's have a look at what the market's saying for implied volatility and what's the expected move by that day. I want to understand, does the market see this as a volatility event, or are they fairly calm around that situation? So I'm going to go to my chart here, and I'm going to put this over here, and I'm going to go 24th. So this expires on that day, the 24th. So that will cover that. And again, 61 points. 61 points in Aussie dollar. If we go back to that chart, it doesn't smell like fireworks. So again, we've got this coming up. Potentially, the market's saying after this, we really don't see much more of a move than 72.50, which really sort of puts us in line with we're sort of down to these kind of levels here. So again, the market's not seeing fireworks. I disagree, though, and they're basically saying that we expect this to be well forecast. We don't expect the forecasting to have too much errors. But let's just say we do get a weak employment number tomorrow. Let's just say we do get a trim mean number on the quarter at 0.3%. The next thing I'll look at is what's priced in. So let's go to the rates market. Let's actually understand what's kind of priced in for this situation. So what we know is the way that we'd look at this, and I could spend an hour talking about this again, but the best way we can do this is each one of these months represents a contract that we can trade. And we'd trade price, but in this situation, I've changed this to the yield. It gives us a really clear indication what's being priced into each meeting. So we can see here that for the July meeting, if you take the cash rate at 150 minus 136.50, we've got 13.5 basis points being priced in. So you can see there, if you get the cash rate at 150 minus the yield, it gives you the expected rate cuts that are being priced in for that. Now you can take a view, of course, that if we get good data, those rate cuts are going to be priced out. So in which case you'd look to sell that. Or you could buy it if you thought that rate cuts were going to be priced in. So we've got a 13.5 basis points. Let's divide that by 25, because that's what rate cuts are. We've got about 54% chance of a rate cut by July. Now, there's some time premium in that, but I won't go into that. So look, for the July meeting, if you look at the rates market, which of course the Aussie dollar will look at very, very closely, and so the algos will, we've got a 50-50 chance of a rate cut by July. Now, what will happen tomorrow if we get an unemployment number above 5%, is that will probably go up to somewhere around 60-65%. The Australian dollar will come up 20 pips or so. Then we go to the inflation number. Implied volatility will probably rise because they will say if we do get a weak CPI number, then it really is on. And again, we get a weak CPI number coming through at 0.3% on that trim mum on the quarter. What you'll end up seeing is a situation where that will probably go up to around 75, maybe 80%, maybe 85%. And the Australian dollar will probably come back into these sort of lows around sort of 71. The market is going to say we are going to get a rate cut. So if we have a look at implied volatility in all these markets, it's very low. It's very low across all markets. Why is that? Now let's have a look at these implied volatility. Let's have a look at the JP Morgan global FX volatility. Let's have a look at this aggregated, all global FX markets all into one. Let's have a look at this. Headline there. China is said to weigh stimulus measures to bolster consumption. There you go. Very positive headline coming through. Okay, so let's have a look at this. So this looks as implies volatility in G7 markets, and you can see there 6.16%. It's the lowest since 2014. So the market's very calm. Why is that? Well, I think it's because all central banks have all moved in alignment. They've all moved to this more sort of realistic, dovish, neutral structure. They've all moved to say that they could become more accommodative. The Fed have said, certain Fed members have said, yeah, look, we could cut rates. We don't expect to, but we could do. The market's already saying that they're likely to cut rates. The RBA have said, yeah, look, we could raise rates, we could cut rates. The risks are symmetrical, but if we are going to cut rates, it's because inflation's going to continue to drop down and unemployment might tick up. In Europe, we know they've said, yeah, we might tier the deposit rate. That might allow us to cut the interest rate. We may look to do more QE. In fact, some ECB members have even floated the idea of buying equities as a result of falling inflation. And if we saw that, then I would be buying the DAX as with my ears pinned back. I think if we start seeing a realistic conversation that quantitative easing is going to ramp up again in Europe, and they're going to not have enough bonds to buy, and they're going to start talking about buying equities as part of QE, and that conversation is being floated, although the barriers I think are very, very high. Then you want to be looking at very, very strong European assets. Remember that the fund managers are still considered as their number one shorter market at the moment. Then I think you're going to see European stocks absolutely fly in that situation. It's not there at the moment. But they ultimately, to answer my question, is why have we got such low implied volatility? Well, it's because central banks are all doing the same thing at the same time. They're all moving in the same direction. What we need to see is divergence. It's what creates high volatility, and what's going to create divergence at a central bank level, where one is saying we're going to cut rates and the other one's saying we're not there, we're more, we've still got more data to play out. That's where we start seeing those diverging paths, and that's where we start seeing higher volatility in FX pairs, and we are getting to that point. And that's kind of like where I wanted to go, and that's kind of where I'll wrap it up. Really, is this idea that we are now starting to see signs of divergence potentially on the horizon, and that could be the triggers that I've mentioned there in Australia. That said, because there is still 50-60% probability of a July cut, if we do see a strong employment number tomorrow and we see inflation which beats the upside, of course those rate cuts are going to be priced out, and the markets are going to say, look, we're probably not going to get rate cuts this year in Australia, and the Australian dollar is going to rally, and then we start thinking about positioning, and that's where we start looking at the different playbooks for currencies. Now, in Europe, we've seen what's happening there, where we start seeing stabilization in data. Again, we're looking at the PMI data, the market's short. Do we see a high euro? In the US, we've talked about what's happening there. But to get high volatility, we need to see divergence at a central bank level. Divergence at a central bank level creates trends in bond markets. It's why we look at the difference between front-end bonds. You see difference in relative pricing structures in the rates market. And that's when you see great trends in FX market. As a macro guy like me, you want to see a trend in an FX market. You want to be jumping on the trend. Okay, we're not going to get the bottom, we're not going to get the top, but we want to get that trend. If you're an Elliott wave guy, that's the sort of the wave 3 that you really want to be catching in that situation. Now, Another trade that I really like at the moment, if you think that we're going to, if you're sitting there at home going, look, Chris, I really think we're going to get an employment number in Australia around 4.9%. I think we're going to get a trim mean number at 0.4, maybe even 0.5%. I think you're wrong. I think, there's some upside to these inflation numbers. And okay, fine, we saw a weak one coming from New Zealand today, and some people have extrapolated that could mean we're going to get a weak one here in Australia as well. But I think the setup that I think looks really interesting is this one of Euro Aussie. Now, I'm not going to buy this or sell this or do anything with this right now. But I think if we do see, China continuing to go the way that it's going, and if we do see better employment data, if we do see that, and what I like about this is we wait for the market to tell us that they're quite like this, and if we see a close through this horizontal support level, of course, we're watching to see how price reacts. But I think if we can get a daily close, if preferably a weekly close through this floor in the market, I think we're going to start seeing Euro Aussie trend lower. I think that's going to be a great trade. That said, if we do get a move through this sort of neckline here of this double bottom that we saw through here, about 158.80. I think that probably could see some good upside. So I think you're just waiting for the market to push you in. You hear this term patience all the time from professional traders on Twitter coming out and saying you've got to have patience, wait for the market to push you into a trade. This setup on Euro Aussie, I think, looks really, really interesting as well. Now, I just want to leave it on one other trade that I get talked about all the time, and that's what my view is on gold. I put out a white paper last year on my view on what happens with gold, and that was really based on the idea that we were going to see increased negative, the amount of the pool of bonds with negative yields was going to increase. Potentially, we're going to see some downside for the US dollar this year, and I can go on about the US dollar for ages. But also, it was a really good hedge against economic debasement, economic concerns. And that trade worked out really, really well for quite some time. But now we're in a situation where we've started seeing better global growth. As I talked about, China is the epicenter of the world for that situation now. And if you have a look at this white line here, this is the total pool of bonds with a negative yield. If the government, a negative yield, for example, means that if you're a government and you were to go and issue debt that had a negative yield, then the people that you're effectively borrowing money from would pay you to do that. So it's like me going to ANZ and saying, I want to get a mortgage. And they're like, how much do you want to borrow, Mr. Weston? I'll say $500,000. And they say, well, okay, fine. Here's your $500,000. And you know what? We're going to pay you 4% for doing so. That's the perverseness of a negative yield. Why would anyone invest in a bond with a negative yield? Well, of course, you still get the capital appreciation. Negative yields can go lower, and then you get a capital return. In that situation. So you would trade them, you wouldn't hold them to maturity because you would lose money, but effectively in a situation, negative yields can go lower and you get a capital return. But what we can see here is a negative yield across this world, and at this point we had over $10 trillion of bonds with negative yields. And gold did very nicely. There's this correlation caught up in September. It started moving up quite nicely, and what we saw is this pool of negative yields represented concerns around global growth. We saw disinflationary forces, bond yields moved lower, and effectively gold started moving up. So that, I see people on Twitter coming out and say gold's a great hedge against inflation. Yeah, well, maybe it was once upon a time, but what we've seen really since September is gold's been a hedge against against economic uncertainty, economic fragility, and lower bond yields. And of course, the fact that gold has no yield is yield in itself. When everything else is becoming negative, the fact that gold has no yield is perhaps where we get this store of safe haven demand. And now what we're seeing is better times. People are selling out of bonds. Bond yields are moving higher. We're certainly seeing that very aggressively in China and to an extent in Europe, in US. And that pool now sits at $9.5 trillion. Now it's come off about 9% from these highs. But you can see that we've seen, gold establish that situation there as well. So what's going to cause gold to move lower or move higher? Well, you buy gold at the moment as a portfolio hedge against global uncertainty. If we see continued economic prosperity or stabilization, then you really want to be out of gold. In fact, if I go to the chart of gold, and I'll firstly touch on that in US dollar terms, we've seen a break of this. It's not a particularly straight line there, but you can see there it's touching all the right points, and gold is now price is trading through there. It's looking weak. You've got the head and shoulders pattern there. It's trading with this in this channel. Gold at the moment is looking like it needs to be traded from the short side. I was bullish earlier in the year. At the moment I wouldn't be long. With this pool of negative yield falling, if we do see better data, continued better data, and I'd keep my eyes on what's happening in European PMIs. I'd keep my eye on the retail sales over the next couple of days in the US. If they come out better, yields are going to continue to move higher. Gold's going to continue to go down. We'll probably come to test this uptrend, and that will continue working out to this 200-day moving average. That said, what we always want to do in a dollar-denominated asset like gold is actually look at this in the weakest currency. So we're going to be looking to trade. If you want to buy it, you look to trade it in the weakest currency. If you want to short it, you want to be short gold in the strongest currency. So what we want to see is a situation here. What now is the strongest currency? It's probably the Aussie, or it's probably the euro. It's probably where we offer this in two currencies there. So we offer this in US dollar terms, Aussie dollar terms, and euro terms. If I have a look at that in US dollar terms, it's breaking through there. We're seeing price action. Few sellers try to retest that hone in. We tried to retest the neckline. The sellers have come in. It's looking weak. This looks like we could see some sellers come through, and we could come to test this uptrend here. But if you're looking to short it, you want to be short in take that dollar exposure out, and then change that into the strongest currency, which looks like it's the Australian dollar at this point. And if we have a look at the technicals here, we can see that clearly this looks a bit weaker there. We've got all the sort of rising trends and whatnot, all working quite nicely. So, if I'm looking to short gold, I'm going to do it in the strongest currency, which right now is in Aussie dollar terms. So that looks like it's pretty weak there. Again, it's going to be largely down to what's happening in the employment data. But, you're seeing all the rallies being contained into the 5-day exponential moving average, which is a bit of a concern for gold bulls. But that may change round if we do see economic fragility kicking in again with what's happening in the trade dispute. If that doesn't come to fruition, then gold will work very, very nicely indeed. But one suspects that Donald Trump will make sure that isn't the case, because he's very, very keen to keep the stock market rolling on into the election in 2020. He sees that as a voting mechanism in his tenure. So one would be very surprised if we didn't see a market-friendly result. What does a really market-friendly result look like from the trade sanctions? Well, I think it's a very united China, very united US, and I think they remove all the tariffs. I think that's not priced into markets, in which case, I think the Aussie dollar will rally nicely. I think you're going to see gold coming under pressure there as well, but we don't know when that's going to happen. But for now, I've moved to the sidelines. So the idea here is I'm just trying to understand what makes gold tick. And I think for me, I think this chart here really proves what we've been seeing. It's not a hedge against inflation. It's not a hedge against this, that, and the other. It is a hedge against economic uncertainty, and the disinflation that causes bond yields to move lower, and we see a bigger pool of economic negative yield, and also lower real yield, and gold prices seem to do that. But now what we've been seeing is the technicals breaking down. It feels like gold has further to go in the short term. I certainly wouldn't be buying it in that situation. But if you love gold, you're probably in a situation where, unfortunately, you want the global economy to turn down in that situation. So just to recap, because I'm sure there's a lot of people out there who want to go and have your dinner. We've got a situation now where we're looking at the playbook around what's going to cause this. At the moment, we've got very, very low volatility around the world because central banks are all going in the same way, and they're very supportive of risk assets. We've seen oil prices moving up, and again, that's given us some situation. And you've got a situation where we've talked about what's happening in implied volatility and the low moves, and how we can use that to assess how much risk to take on over a specific time frame that suits you. I mean, obviously, if you're a scalper of markets, you're not going to use a 1 week volatility structure. But I talk to scalpers all the time who use expert advisors on MT4 and MT4, and they say to me, Chris, why do I need to know about all this fundamental stuff that you talk, all this bullshit fundamental stuff that you're talking about? And I'm like, well, EAs are really, really great tools because they take a lot of the emotion out. And certainly if you can backtest something and you can get an edge, that's fantastic. But why do people lose money when we see, trading EAs? And it's because that they don't take into account that the EA is not it's not artificial intelligence. It doesn't change. It's not adaptive. It doesn't react to market conditions. It does what it's told to do. And for me, in that backdrop of what's actually happening in the backdrop by which their EA is working in, they don't adapt to that. So if I'm talking to people, like I say, well, actually, if you understand the operating environment, low vol, high vol, trending, whippy, all these kind of situations, you can have a higher probability that what it's trying to achieve can have a better success, and then you've had this positive expectancy in your systematic strategy. So these kind of fundamentals really matter for people who are whether you're a hardcore technical guy or whether you're someone who uses a systematic strategy and really doesn't care what the Fed are saying. The backdrop by which markets operating means that you need to adapt. And with low vol, personally, I'll be looking at carry structures. I'll be looking at high yield. It's why yield has fallen in the equity market. People have been bidding that up as well. So volatility for me is the epicenter of the financial markets. It is really how we define structure. It defines how how much risk we're going to take on a position, how our position size changes. And for me, some people use realized volatility. Implied volatility is whatever your strategy, whatever your walk of life, it is the epicenter of what we're doing in these markets. And volatility chooses our asset, whether you want to be in the yen for protection and risk aversion, or whether you want to be in a high yielding emerging market currency. It defines everything there. So my advice is get an education around that. I mean, I'd certainly be looking at how you trade implied volatility, how you find out implied volatility. Sign up to my daily fix, which you can see here. And again, that's on the handout. You can reach out to me and write to me and ask questions around this sort of thing. When we will be doing live updates on a daily basis around this situation. But for me, it's really important to get a grip about how volatility affects markets, and how it affects your position, and how it affects the outlook for economic data. Because that's event risk, and that feeds back to the issue that I talked about at the very beginning, which of course was part of my process is understanding positioning, understanding sentiment, and how we select opportunity. And of course, there's lots of other components there as well. But this is just a fraction about how I go about doing my process. And I could talk for 5 hours on this subject because it's very detailed. But I think there's enough to scratch the surface. And certainly, if you are interested in this stuff, I'm more than happy to talk you through and go from there. But I appreciate your time, giving up your Wednesday night. I hope you all really have a great Easter. And as I say, chris.weston@pepperstone.com. If you have any questions around some of the crazy content I've talked about, then I'd obviously love to get in touch with you. And obviously do sign up to my daily fix for my daily thoughts and go from there. But I wish you all a happy Easter, and I hope you get a chance to get away from work as well. Thanks, guys.